This video is covering a property purchase with some twists, some details, some variety. Let's take a look. We'll start here with the settlement statement. I've already created the journal entry, and so we could just walk through it, and you don't have to watch me create all the categories and fill in all the details. First, the contract sales price, and this is a fixed asset account. This is presuming a buy and hold type property as opposed to a flip that we would book to the profit and loss, the P&L. We're going to book this to the balance sheet as a fixed asset. And just the sales price. Next, we have a construction holdback. So this is a part of a loan that is actually an asset because it's being held back at closing and the money's not advanced yet. So we're debiting it. It's another current asset account. When it's paid out, that will reduce the asset. Of course, it would credit the asset, debit checking. Okay, next is the settlement charges to the borrower. And here's where we need to pay close attention. We can capitalize the closing costs, but not the loan fees, not the costs associated with the loan. And we also don't want to capitalize anything that's put into escrow. So the first part of the settlement statement is always going to be the summary, and then you'll have detail. So if we go down here to see, now this property closing costs, you could roll it directly into the property. I like to put it up as a separate fixed asset cost, or separate fixed asset item, so you can see those closing costs separately. And of course, I would use classes so that you can run a balance sheet and a P&L by class, and then just have your category such as land, building, closing costs. So the commission paid at settlement, that's going in here. The title charges, all this, that's going in here. And these recording fees. So if you look, and I like to put this into a Google Sheet, even from the statement PDF, so you can do things like this. So I have the commission, then I have these title charges, and then I have these three here. And you can see my sum here, 99.50. Great. That's exactly what I want. Next, taxes and insurance escrow. So it's required by the lender, and it's going to be placed into escrow. So we have this insurance, these taxes, and then an adjustment. Total 3826.95. That's how we get that debit. That's another current asset. It's being held by the escrow company, but not paid out yet. It's not an expense yet. It will be when it's paid. Loan fees, separate, cannot be capitalized, should not be capitalized. So that would be all of these, 5615, 5615. Also, these, where are we at? Here we go. Paid by the seller in advance. These taxes, these are expensed. These three here. And I like to list them out separately so you can just match them up without having to add them. You could combine them, that's fine. Then we have the loan principal amount here. That's a credit to the liability to establish it. Then we have earnest money deposit or purchase deposit, total of $15,000. Now, when that was made, usually that's made before closing. That would be you're debiting the asset, and now you're crediting it to clear it out. Have a little bit of rental income here. And security deposit, that's a liability. because it's typically refundable to the tenant. And then last, we have the cash due at closing. That's should be what we see in the bank feed coming out of the checking account, so crediting the checking account. And of course, our debits and credits match, which is exactly what we need to have. So this is the settlement statement again, and as it flows over into a journal entry matched in the feed, and then you see it reflected on the balance sheet and the income statement.